Investing can be daunting, but it doesn't have to be. Many financial experts are using heavy technical terms and jargon to make it sound like it's very difficult, and that's how they can sell their products to you.
Can you pivot and adapt within the Institute's ecosystem to deliver a collaborative fleet dynamism?
This video, we are here to disagree with that notion. Learning how to invest confidently can be highly rewarding and fulfilling. Burton Malkiel, the author of A Random Walk Down Wall Street and a very well-known economist, is a fan of this DIY approach. So in this video, we are going to learn how to create a 3-fund portfolio, which is supposed to be the laziest way to invest, but is still risk managed, easy, low cost, and supports evidence-based financial investing. I'll be using Vanguard funds as an example and showing you step by step how you can personalize this portfolio for yourself. So let's dive right in. If you're looking for a quick snapshot of the 3-fund portfolio and don't have time to watch the entire video, here it is. The US total stock market, VTSAX, the international stock market, VTIAX, and the bond market, VBTLX. This 3-fund portfolio contains a combination of stocks and bonds. Because stocks and bonds are inversely proportional to each other as far as the price is concerned, so when the stock market crashes, bond prices rises, and vice versa. This is an effective strategy in managing your risk, especially if you're older and you're about to retire. If your portfolio cannot deal with a massive crash in the stock market, you want some protection from the bonds. A general rule of thumb to choose the percentage of bonds in your portfolio is kind of close to your age. If you're 30 years old, you want 30% bonds and 70% stocks. In my opinion, 30% bonds is a little bit too much, but here's where a personalized preference comes into play. If you're extremely risk averse and you cannot tolerate a lot of stock market ups and downs, especially like the one that happened in 2020 where the market went 30% down, but it did recover pretty quickly, you could be the type of person, if they had 30% bonds in their portfolio, they would have been much more comfortable seeing the entire stock market crash because the bond prices would have gone up. But I believe that using index funds is diversified enough that I don't have to worry too much about the stock market crashing, because I live within my means and I know when to curb my expenses so as to not turn my paper losses into real losses. As far as the total stock market and the international stock market percentages is concerned, you can play around with it. The international stock market is usually considered higher risk than the domestic stock market. So the VTSAX on Vanguard's site is about 4 out of 5 on the risk scale, and the VTIAX actually is 5 out of 5 on the Vanguard's risk chart. That means if you have 80% stock, you could do 65 and 15 VTSAX and VTIAX. I tried researching a lot, but there wasn't a lot of evidence behind choosing the percentage of domestic versus international stock. If you know more about it, please don't forget to comment down below. So in summary, for a 3-fund portfolio, the simplest allocation that you can create is 80% stocks, 20% bonds. But if you have other sources of passive income and financial means, for example, consistent paycheck, and you don't mind the risk, I know another popular investing approach is just the 2-fund or even 1-fund portfolio. In the 2-fund portfolio, you would not have any bonds whatsoever. You just have VTSAX, VTIAX, whatever percentage you are comfortable with. For a 1-fund portfolio, you could go as simple as just putting all your investment money in VTSAX, because it is tracking more than 3,500 companies and you get enough risk management that way. Plus, most of these companies are also doing business in the international markets, so you do get the international exposure. This portfolio is also extremely low in cost. VTSAX only has an expense ratio of 0.04%. That is $4 to manage a $10,000 portfolio. I'm only talking about Vanguard funds here, but if you like, you can also buy similar funds at Fidelity or Schwab. All these brokerages have extremely low expense ratios. The best way to get started is to automate your investments. So figure out what percentage of your salary that you want to save and invest that first, and try to live within that remaining money. That way you can set a hard number on your savings. Say it's 30% that you want to invest, and you just direct it away from any of your savings or checkings accounts, so you don't even have access to it. It's sitting in a brokerage account. and it's really far away from you, and you have that mindset that this is the money that you're going to use after 10, 20, maybe 30 years. This type of portfolio also makes it extremely easy to use this money because it's all consolidated in one place, and when it's time, say you want to take an early retirement or a sabbatical or even traditional retirement at 60 years of age, you can just take money out of this portfolio using the 4% rule and have your finances very easily managed. One thing that we need to talk about this portfolio is balancing. Now you may ask, what does balancing mean? Stocks and bonds and these markets are ever moving. So sometimes it's possible that the stock market grows really aggressively and your portfolio may get skewed. If you had started with a 70-30 split, you might see that your stocks went to about 90% and the bonds are only 10%. If you're about to retire and that much risk is too much for you, then you might want to balance this portfolio every year. Balancing is nothing but selling some of these stock funds and then buying bonds so that you can rebalance your allocation based on the 70-30 or whatever percentage that you set for your own personal goals. Usually it's a good idea to balance once a year so that you don't have too many taxable events, and many people love to balance on their birthdays. If you think balancing is a lot of work for you and you might as well give someone else the control, then Vanguard also offers certain target retirement funds that you can buy, and they'll be self-balanced till that target retirement age that you want to set. For example, if you are 30 years old and you're going to retire in 30 years, which will be 2051, you can buy a target retirement fund that is dated at 2051. So this fund will be rebalanced automatically, but you'll just have to pay a little bit higher of an expense ratio. It is close to 0.15%. It's still not too bad. Another example of a fund that balances itself is the Vanguard Life Strategy Growth Fund, which gives you an 80% stock and 20% bond allocation and rebalances automatically. The expense ratio on this one is 0.14%. These were many ways to create and build long-term wealth. Remember, the key is consistency and automating your investments. The more time that you give these investments in the market, the better that your growth and returns will be. Other places where you can get low fees investing is robo-advisors like Wealthfront, Betterment, and M1 Finance. They do have slightly higher management fees, and you have to pay the expense ratios of the index funds and ETFs that they use inside their portfolios. For example, I remember investing in Wealthfront and their fees was 0.25% plus any expense ratios that the funds were charging anyway. Once I educated myself about index funds, ETFs, and these 3 fund portfolio strategies, I went ahead, opened up my Vanguard accounts, and did all my investing DIY. And so can you. So if you have cash sitting in a bank account, please go ahead and invest it. If you want to do nothing, the robo-advisors are great. Betterment, Wealthfront, they are all using evidence-based investing, and they are looking at your future long-term. And because their fees isn't that high, it's alright. Any place where they're charging you more than 1% of your portfolio for management fees, I would stay away from it. There is data that shows that when advisors charge about 2% management fees in the long term, your portfolio could be reduced by up to 50%. So don't be afraid to DIY your investments. It's not that hard. The simpler your portfolio, the easier it is to manage. I hope you got value from today's video. And if you did, please don't forget to hit that like button and subscribe to my channel for more such informational videos. If you do end up investing after learning something from this video, please don't forget to share in the comments below for the rest of us to learn as well. And I'll see you in the next video. Bye.